Okay, good evening once again. We are continuing with our lesson on stock exchange. In our last lesson, we learned about what stock exchange is all about. Then we learned about other aspects of it. We didn't waste time talking about those things that we learned. Where we ended, we are going to continue. Today, we are going to talk about the members of the stock exchange. So if you look at the topic, I said members and other dealers. In other words, when you go there, in Ghana, we have learned that ours is the Ghana Stock Exchange. Who are the members there? Remember, we learned that it is an organized market where securities are either bought or sold. So who are those engaged in the activities there? And they are the members. Apart from those members, there are other dealers in the stock market, and you know very soon who they are. So the two main members that we have at the stock exchange. Remember, we said you as an individual, as a member of the public, cannot just go to the stock market and then you say, I want to buy shares. Then you go and buy shares. Or I want to sell my shares. Then you go and contact anyone, then you sell the shares to. No. It is not like the market where goods are sold, where if you have your money and you want to buy tomatoes, you just go to the market, you see the seller. Once you have the money, then you engage her, and then whatever you want to buy, you buy. That is not what happens in the stock market. What happens there is that we have two main members. Number one, we have the one we call broker, or we can qualify it and say stock broker, because when you go to another topic, there is somebody we also call broker there. So we qualify this one for us to know that when you talk about broker here, we are looking at the stock broker. In agency, you learn about a broker. But here we are looking at stock broker. Then the other one is the one we call jobber. So I said the members. So the two main members, we have the broker. That is specifically, we are looking at the stock broker. You know, stock refers to shares. Stock refers to shares. So we are looking at the stock broker, then the jobber. Now, what do they do there? As I indicated earlier, you cannot go to the stock market and then you say, I'm buying shares. Don't forget that you have learned that stock exchange is a secondary market. And that concept has been well explained in our previous video. So you know when you say it's a secondary market, you know what is meant by secondary market, and you also know what is meant by primary market. Don't forget the IPO, the initial public offer, which we said is the primary market. And then when you buy shares and you are no more interested in investing in the company, you can decide to sell your shares. You don't go to the company and you say you want to sell your shares, so you sell the shares to the company. That is not what is done. What is done is that you go to the stock market. That's why we say it is a secondary market. So after you have bought the shares at the IPO, you go, if you are no more interested, you go there and sell. Somebody too will buy. But you cannot just go there and be looking for people to sell their shares to. So the first person, as a member of the public, you are called a client. A client is somebody who goes to see somebody for service. So a doctor, a lawyer can have a client. So when you go to the stock market, the first thing you have to do is that you have to go and see a broker. Then depending on what you want the broker to do for you, he quizzes you, he asks you certain questions and whatever to even find out whether you are even interested. Assuming you want to buy shares, whether actually you want to buy shares, because you see it takes a longer period for you to benefit from the purchase of shares. Don't forget that we said when you buy shares, there are two main benefits. we talk about the income benefit, that will be the dividend that you receive, and then we also talk about capital gain. They want to find out whether actually it's shares you want to buy. Maybe you want to buy treasury bill, and that is not the place you have to go. So if you don't have a long-term investment purpose, then they may advise you that because of the way your objective, you want to find out your objective, your financial objective. If he sees that it is not shares you need, he would advise you. But if it is actually shares you want to buy or shares you have and you want to sell, then you see him, he picks it. Then he will go and search for the right person for you. And he's the one we call jobber. So you come to the jobber. So the broker will now pick your shares, see a jobber, sells the shares to the jobber, and then he takes commission for the services he has done for you. That is why we say the broker is an agent. When you come to agency, which is in your book too, we shall learn about another person we call broker there. So as an agent, or agents work for commission. So he works for you and then he takes his commission. But remember, the broker cannot advertise for shares. He cannot advertise, but he can give you advice. That's why when you went there, you saw him, you are asked certain questions, then depending on whatever the case might be, he gives you advice as to whether you should buy the shares or you should invest in something else. So if you look at this diagram that I have here, so I said brokers, they are agents who serve as intermediaries. So they are between, look at this diagram. If you look at its client, and then I said the investor, somebody who had already invested, then we have the jobber here. The jobber is actually the one who buys and keeps shares, but you cannot go and see the jobber, so you have to see the broker. So if you look at these arrows, the goes here, it also moves here to tell you that you go and see this person, then he gives you feedback. So the broker is the one that goes to the jobber, and then he deals with the jobber for you. Then if it is about sales of shares, then he sells the shares for you. If you want to buy shares, the broker, we shall go to the procedure involved in purchasing shares at the stock market, and we shall talk about certain things there. You go and see the broker, he has to open an account for you. We call it depository account. And then it's like you have gone to bank and then you open bank account. That is how it is. So you buy, you sell, everything goes on there. When you go to the procedure, we shall talk about that one. So let's limit ourselves to this one. So in here, the broker, we said, is an agent. So he is an intermediary. That means he acts between, if you are a Christian, you know the Christians say Jesus Christ is the intermediary between man and then God. So we take the broker to be man, then the jobber to be God, then the jobber to be God, then no, the client to be man, the broker to be the agent. That would be Jesus if he were to be in the church, and then this one would have been God. So he is between the client, who is the investor, and then the jobber. So that is for that one. So we said agents who serve as intermediaries between the public, that is the investors, and then the jobber. Now, if you look at this one, I've indicated here, there's a link between the broker and the investor. I said he's not allowed to advertise shares, but he advises, or they advise. So what is there is advice. So they advise their clients. So that is for the broker. Now, we have learned that the broker will go and see the jobber. So we have already done who the jobber is. Whilst the broker is an agent, the jobber will be a principal. When you go to agency, you learn about the relationship between the agent and the principal. Once you are an agent, the other person is a principal. And the agent works for the principal for commission. So the jobber or jobbers, they are principals or they are wholesalers. They buy shares and keep the shares. The broker doesn't keep shares. The broker, you go and see the broker, he picks the shares, then he will go and search for a jobber who will buy it. But the jobber will certainly keep the shares. Now, when the jobber buys the shares, assuming he bought shares at let's say 10 Ghana cedis, then he sold that particular share at 15 Ghana cedis. You know, if I ask you the profit he has made, you'll be able to tell me. Certainly it's 5 Ghana cedis. This, if you take this from this, it will be left in 5 Ghana cedis. This will be his profit, and that is what you call the jobber's turn. So when you say jobber's turn, you are looking at the jobber's profit. So they buy shares, they sell, and then the difference between the buying price and then the sales will be their profit, and that will be the jobber's turn. Now when you go to the procedure involved, we shall learn that the jobber holds two prices, and we will learn that about that one. So let's wait. When we get to the procedure, we will talk about that one, what the first one means and what the second one means. So these are the two main members of the stock market. The jobber knows that he buys the shares on his own account. So he buys shares and he keeps shares. So take note of that one too. Now, apart from these two members, we have said these are the two main members. Apart from them, there are other dealers in the stock exchange. Remember, when you say stock exchange, you know what it is. There are other dealers. Remember, people are engaged in business. It's about buying, selling, and then making profit. So what happens? Now, apart from these two members, there are other three dealers in the stock market, and we call them speculators. Now it comes from the word speculate. If you tell somebody that the person is speculating, what does that mean? I'm not your English teacher. You JHS, you have done English language from JHS up to now, so I'm not here to explain to you what is meant by to speculate. You should understand what is meant by speculation. So if somebody is speculating, what does that mean? That is where they get their name from. Then others also call them stock exchange animals, because they bear the names of animals. They are three. Now, what is speculation? There was a year they asked them a question. What is speculation? Now, what are other synonyms of speculation? Now, I can say anticipation. So when you say speculation, you see, at the stock market, prices, remember in our first video, I said it is the interplay of demand and supply that determines the price of shares. Just as demand and supply determine the price of commodities or goods in the market, in the same way, it is the two that will determine the price of shares. So if you are a company and you are doing very well, you are making profit, people will demand your shares. And as demand exceeds supply, prices will be moving up. And that is where most people will be investing for the capital gain that we have already learned about. Because if you buy shares and let's say 5 Ghana cedis, and you're able to keep it for 20 years, and by 20 years time, the price of the share had moved to, let's say, 15 cedis, then you can imagine the quantum of profit you are going to make. So you see, that is the main reason people actually invest. So what happens is that there are some people who study the stock market, and they have done it, they are experts. So they know certain conditions will prompt them to know whether prices are going to increase or prices are going to fall. So there are some people in the stock market, all that they do is that they'll be monitoring events. Now, when they monitor events and then he anticipates, that is where the name speculator comes from, because they are anticipating. You know, a lotto forecaster, even though the numbers, let's say Saturday, today is Monday, the numbers that are supposed to be drawn on Saturday, the person can sit down, look at certain events and a whole lot of other things, and then predict that 26 will come, that 16 will come. But please, I'm not asking you to go and stake lotto. So I'm just giving that one as an example. So don't go and stake 26, 16. It's not a lotto number I'm giving you. So he speculates that this is going to come. That is what some people also do at the stock market. They look at certain things, then they can speculate. Another example I can give you before I even come there is, there are some people who are into this foreign exchange market. They can be there and they say that no, next week is likely, now the dollar is 12 Ghana cedis. It will be 14 Ghana cedis next week. So what do? They go and buy the dollars now. So that next week, if it goes to 14 cedis, they can sell. That is what happens to at the stock market. If somebody studies and the person realizes that maybe next week the price of a particular share will increase, or prices of shares will increase, what is the person going to do? Let's assume the price of share is now, okay, let's come here. Let's say the price of share is 10 Ghana cedis now. A particular share is 10 Ghana cedis. Then the person anticipates, the person speculates that the price, but next week, the price is likely to move from 10 cedis to 15 cedis. So this person will now go and set, then he buys shares at this price. So this person can decide to buy, let's say, 1,000 shares. Now, if the person buys 1,000 shares at 10 cedis per share, then you see it's going to be 10,000 cedis. 1,000 times 10 will be 10,000. Now, if his anticipations come true, and next week the price of share actually increase from 10 cedis to 15 cedis, he will sell the shares at 15 cedis. So he bought at 10 cedis, he will sell at 15 cedis and make profit. So you can imagine. So it's not going to be. So he will now sell at the 15 cedis, make 15,000 cedis, and his profit will be the 5,000 Ghana cedis. Such a person is called a bull. So a bull is a speculator in the stock market who anticipates an increase in the price of share, and therefore he takes a certain action. And what is that action? The action he takes is to go set for the shares. He buys the shares at the current price, so that if his anticipations come true, then he will sell the shares and make profit. Let me tell you something about the stock market. We shall do that when you go to the procedure. But let me tell you something now. Now, if you go to Kotopraba market or any other market, the Kaneshi market, the Sunyani market, whichever market you go and you want to buy something, let's say tomatoes, on that very day, if you are not buying on credit, then you pay the person and then the person will take the money. That is not what happens at the stock market. There, they meet, they negotiate, they have something they call T+3. We shall do that one when you come to the procedure. The day the transaction took place, then 3 days after that day, that is the time they will actually exchange the shares and the money is paid. So if the bull anticipated that prices were going to increase, but his anticipation doesn't come true, then it means the shares that he negotiated to buy will not pay for that one. And that will be breached. If you had done law of contract, which you will do in your book too, you would have known that that would have been a breach. So he will pay something to the person, and that is called contango. Now, in the stock market, the day that they make settlement, they make payment, and they also take your checks, it's called the contango day. And the contango is the, let's say, consideration that the bull will have to pay if he refuses to buy the shares as he intended to. And he may not pay for because prices did not increase as he anticipated. So he will pay that contango. So that is for the bull. The second dealer in the stock market, and you see, bull is a name of animal. That's why we said they are stock exchange animals. So we have the bull, and the second one is called bear. If you don't know a bull, if you don't know a bear, then that one, it means you did not go to class 4 or class 3. Go and pick class 1 dictionary. You see what a bull is, then the bear, and then the stag. These are names of animals. And if you actually went to class 4, then even class 3, you know all these things. We are the bear. Who is the bear? It's the opposite of the bull. Look at it. Whilst the bull will anticipate that there is going to be increase in the price of shares, the bear anticipates that prices of shares are going to fall. So let's come to this point again. Assuming the price was 15 Ghana cedis, then they study the market. Remember, it's their business, so they actually study the market and they know certain things. They know certain things because it's their business. So they study the market. If prices are going to increase, they will know. If prices are going to fall, they will certainly know. But know that once it is anticipation, it may not always come true. So if the price is now 15 cedis, and because of one reason or that somebody anticipates that no, by next week the price will fall to 10 Ghana cedis. Now, what do you think will be the wisest decision this person will take? Okay, I have shares with me now. Let's say I have 1,000 shares. Now it's 15 cedis. If I want to sell to somebody now, I will sell the share at 15 cedis per share, and I'll make 15,000. Next week, the price will fall to 10 Ghana cedis. What do you think will be the wisest decision that the person will take? Now, if your thinking is that the person will go and sell the shares that he or she has, then you are right. That will be the wisest decision you have to take. So now that you have the shares, the bear will go and sell whatever he has, anticipating that the price will fall. When the price falls, what action will he take? He will go and buy the shares at that price. So now 15 cedis he sold, he had 15,000. The price will fall to 10 cedis. So he will now go and buy shares at 10 cedis. He had 15,000. He spent 10,000. He has made profit of 5,000. So that is the bear. And the market where prices of shares are falling, we say that is the bear's market. On the other hand, when the prices of shares are increasing, then we say that is the bull market. So that is the difference between a bear and then the bull. That is why people say that the bear is pessimistic and the bull is optimistic. If you don't understand pessimistic and optimistic, check your dictionary and you know who they are. So that is for that one. The last dealer in the stock market is the one we call stag. The stag. Now, there is a relationship between the stag and the bull, and don't get confused. Both anticipate that there will be increase in the price of shares. So that anticipation is there, whether a bear or a bull. So more often, students find it difficult There are some students, when they are writing about stack, then they'll be writing about bull. Be very careful. Note the difference. Now, for the stack, remember the bull at the secondary market where they have shares and then they don't have the shares and they anticipate that the price of shares are going to, or the prices of shares are going to increase, then they will go and buy the shares at the current price and sell when the price actually increase. For the stack, when a company comes and they are selling their shares, new shares, you see, they anticipate that because the companies may want people to buy their shares, the shares will be sold at lower prices. And for that matter, the anticipation is that very soon prices of the shares will be increasing, all things being equal. The price will be increasing. Now, so the start is not somebody who actually comes and then he's buying the shares as an investor. No, his aim is to buy the shares so that when prices increase, he will sell the shares and make profit. That is who the start is. So they buy shares, new shares, keep the shares, and sell the shares when prices increase. Then they will sell the shares and make their profit. So that is who the start is. So take note. So I have done this thing. I've already explained to you, and I have captured it here like this. I said bull, and the bull anticipates increase of the bulls. Okay, this is a bull anticipate increase in price. Then once the person anticipates increases in the price of shares, then the person will buy. So buys at the current price. Then what is the next thing? Then sells when prices increase. Then I've also talked about the bull market. I said in the bull market, prices of shares will be increasing. Then the bear, I said the bear anticipates a fall in the price of shares. So what happens? The next thing he does is to sell what he or she has or what they have. Then when they sell, then what do? They buy them back when the prices fall. And I've indicated that the market where prices will be falling is called the bear's market. So that is that. Then the stock, I said, deals in new issues. That's new shares. Then that is the IPO. What is here is IPO at the initial offer. Then so they deal with new issues, anticipating that prices will increase. When prices actually increase, then they will sell and make profit. So this is where we will end this video. We have talked about the members in the stock market and then other dealers. We talked about the jobber, we talked about the broker. Then we said, remember, listen, you not go to the stock market and you say this person is a bull. It is not like somebody is there and the person is a bull. It's the action you take that will give you the name. So today I may be a bull. I will not be there and always be bullying. No. Today I may be a bull because I anticipated that price of shares will be increasing. Another time, if I anticipate that prices are going to fall, I have become a bear. If a company comes and my aim is to buy shares and I wouldn't keep the shares, when the prices increase, I will sell and make my profit. That is the start. So it is not like you go to the market and there are some people, they will say this is a bull, this is a bear. No, it is not about the person. It is about their action. What they do, that is what gives them the name. So take note of that. Remember, primary market, secondary market too. I told you that you will not go to the market and you see there's a structure here, and the structure is called primary market. There's another structure which is called secondary. No, it is about what are you buying, when are you buying it. If it is IPO, it's a primary market. If after you have bought the shares, you want to sell the shares, that market is called secondary market. Remember, market is not just a structure, it's a transaction that is going on. Ladies and gentlemen, this brings us to the end of our second video. We shall meet another time and continue with the procedure. If you want to buy shares, what's the procedure? Now, remember I put on the WhatsApp platform a seminar organized by Invest in Ghana, and a licensed stockbroker told you what or the steps involved in buying shares. If you have watched that video, then there may not be even any need for me to come back. Till we meet again. If you have any question, if there is something you did not understand, if you want to ask questions for further clarification, you have the comment section there. Just do that. I will go through all your comments and answer the questions on the platform. Till we meet again. Bye bye.